Hello, hello. How's everyone doing? Hope all is well. My name is David. I am the lead trainer here at DoctorVol. It's a pleasure to have you joining me here on my new YouTube channel. We here at DoctorVol want to educate the public about the options that you have, trading for futures and options, and also equity options. Capital efficiency is the goal, and profitability, of course, is the ultimate goal for sure. With that being said, let's dive into what we've got going on today. I'm going to touch on a subject with how to manage a 0 DTE MES position. Right now, we're looking at the MES chart across the 5-minute, 1 hour. This is supposed to be 4 hour. Let me go ahead and change that to 4 hour. And then the daily time frame. So this gives you just a glimpse of what we've been dealing with over the past several weeks. And then, of course, intraday, you can see the 5-minute chart. We're basically trekking upward. So, with that in mind, I've already entered a trade, and let me go ahead and show you the trade that we're currently in. This is a MES position here. This is currently a position that I entered 0 DTE, of course, expiring today. The strike price is $69.45. I pretty much entered this at the money, basically betting 50-50 that it's going to continue to go up. Market had some pretty strong indicators, and volatility is retracting or coming in. So just looking at a number of factors, I said, okay, why don't I flip the coin and go ahead and go into this? Currently, you can see that the position is up $122. All right. And we see that the bid-ask spread is pretty wide. Look at that. It's from 27.75 to 59.25. So to try to get filled on this bid-ask spread, it might be a little difficult because the spread is so wide. I'll go over how to really calculate a decent bid-ask spread, in a different video. You can look up that video on the YouTube channel. I'll definitely be putting it out very soon. But the point is that with this situation, you may not be able to get filled at a competitive price or a good price that you really want. So how can you manage a situation like this in which prices went so far away from your entry or your strike that your quotes, your bid ask becomes pretty wide and you don't have enough activity happening on the chain? Let's look at the chain just to give you a good view as to what's really happening here. So we'll go to the table. We're going to go into the 0 DTE. That's April the 14th. And this is our position right here. You see open interest at 111. It's currently showing. That's what it shows. But you got a wide bid-ask spread here. Very wide here. Let's do the numbers. How wide is that bid-ask spread? You got 31, 50, and then we have 54.75. So if we take that bid-ask spread, the difference, we have around, let me just do ballpark figure here, around $22 or 22 points, you can say. 22 points, all right? So 22 points, and then we can take 22 and divide that into 69.45. Let's go ahead and get a calculator out. Our current price, actually, 69.86. So 22, let's divide that into 69.86. And then let's times that 100. All right, so we have about 0.31% of the price of the underlining is your bid-ask spread. So with equities, it's around 0.1%. You don't want it bigger than that. I would say probably right around the same type of math you want to approach with the futures, options and futures. So, 0.1% is pretty competitive. Now let's look at the bid-ask spread at the money here. We have it's fluctuating now, but you have like $9.90 to $10.40. So that is what? That's less than $1.50. So without even doing the math, let's go ahead and do the math. Okay, so 0.5. Let's say it's $1.50. Let's say it's $2. All right, so $2, and then let's divide that by 69.85. All right, and then let's multiply that by 100. So there you go. Let me see, let me make sure I didn't do this wrong here. Yep. All right. So you have 0.02%. So it's way less than 0.1%. So a very good bid-ask spread. As you can see, it's very healthy. And you'd expect that because currently we're at the money. Now the market's still moving up. Let's take a look at the chart again. Here, you see the market's right now at 69.87. So we've got a lot of green candles happening on the 5-minute time frame. Now, let's go back to this position. All right. Right now, you see the position is up a healthy $122. All right. So basically, that position is, it's profitable if we were to close it out right now and try to get filled with that wide bid-ask spread. Now, how can we mitigate being filled at a competitive price and not abandoning a lot of this profitability here? Well, let's look at something else. Let's look at our trade price. As you can see, our trade price was $20. That's what we paid to get into this trade. We paid $20. Now, the multiplier for an MES options is times 5. So we take that $20 and multiply that times 5. So 20 times 5, of course, that's 100. So that's our total premium paid for this position. Let's go into our analysis here, and you can see what I'm talking about here. As you can see, the maximum loss that you can make right here is $100. That's your premium paid total. The maximum you can gain, of course, is to infinity, because theoretically, this could go up into infinity. Hopefully it keeps going up. So let's say price starts to come back down. Let's say we start to lose value here and we want to protect these gains. How can we do that if we have a wide bid-ask spread or we have difficulty being filled? All right, so the solution to that is to sell a futures contract against it. So just literally go up here and sell it. This gives you, basically this long call gives you the right to buy a futures contract at expiration at the strike price at 69.45. So we're going to be buying this. If we let it expire, we're going to be filled at 69.45. Now, we don't want the broker to say, okay, you don't have enough equity to cover this. You can't do this. So they'll close you out prematurely. You need something in place to say, don't close me out. I couldn't get out of it because of a wide bid-ask spread, but I want to retain this profitability here. All right. So let's do the math. If we were to let this expire to expiration, we have 69.45. And let's say we right now sold a futures contract at 69.90. I'm sorry. I'm not even showing you the screen. Okay. Let me just go back a little bit here. Sorry about that. Our trade price was $20, like I said. Our multiplier is times 5. So the premium that we paid was a total of $100. Let's go into our risk analysis here. All right. So you can see that the maximum loss that we can have on this trade is $100. And this theoretically could go up to infinity. Now, let's say if price started to retrace, back against us and we started to lose profitability here, how can we mitigate that? You know, being that we may be in a situation where we have a wide bid-ask spread as we see here. All right, so let's go back to the position. Let's calculate this. We're at 69.45. Let's say that we sell here at 69.90. Let's say 69.90. We go ahead and sell a futures contract against it. So we will be selling the futures contract against it. All right. So we'd be locked in at 69.90. All right. So only thing we pay for that is the commission, you know, but we'd be in the futures contract at 69.90. Let's go ahead and calculate this. All right. We have the right to buy or own a a futures contract at expiration at the strike price of the call, which is 69.45. So let's take 69.45 and then we can just go ahead and subtract 69.90. Let's say that we short a future at 69.90. So minus 69.90. All right. That's 45 points. 45 points. All right. So as you recall, as I mentioned earlier, that 45 points has to be multiplied by 5. That's the multiplier for an MES options position. So times 5, that gives you $225 of profitability just between the futures contracts that will equate or result if we go to expiration. All right. Of course, this will turn to a futures contract where we're going long the MES futures at 69.45, and then we'll be going short as we're doing right now, as we would do right now if I were to do this right now at 69.90. So that's a difference of 45 points times 5. So that's $225. Now, what's the missing element that we must also consider? And that missing element is that nothing is free. Nothing is free. You buy car insurance, you're going to pay a premium. All right. So we did pay a premium, as we mentioned earlier. That premium, let's go back. What's the trade price of 20 points times 5? It's $100. So literally we need to take $100 out of this. So, sorry. 225 minus $100 is what we should be doing. 225 minus $100. So this is our profit that we have locked in if we are to sell a futures contract against our current position, which has a 0 DTA and expires today. That's what we would get in profit. We basically would be locking in $125 in profit. So if you do have a wide bid-ask spread, and as you can see, the numbers are pretty accurate here. We're up $122 right now. So if we were to be closed at the mid price right now, you know, we could get $122, but let's say it's late in the day. Let's say that the market is so wide that you can't get filled. This is a mechanism that you can use to protect your gains and also to lock in profits and to move on to another trade and idea and have peace of mind that you're not going to be stuck into a position and get filled at a bad price. All right. So this is just food for thought. And if ever you are in this type of situation, definitely keep in mind that you can lock in profits and basically hedge against. I don't like to use the word hedge, but you can basically hedge against any movement in the market and lock in your profitability, or lock in whatever you have in that position and let it go to expiration. And the broker wouldn't be closing you out in this type of situation because they'll clearly see that you have an equal amount of a buy and a sell to offset the position at expiration. So it's not going to worry about how much equity you have in this case. I hope that this video was of help to someone. And remember that